Hey everyone, Jason here from Quant News, sitting here in my empty office. I'm moving house and all my books are gone. Next time you see me, I'll be in a new place, same books. I've been teaching quant finance and algorithmic trading for several years now. Probably 1,400 people have taken my course, and the number one thing people ask is, how do I come up with strategies? Well, what if I told you that it only takes a couple lines of Python to show yourself that you have potential edge in a strategy? That's what we're going to do today. We're going to look at a flow effects strategy using only data and Pandas in what I call minimum viable Python to assess whether there's potential for a strategy to work. And minimum viable Python is all about doing just enough coding that you need to prove to yourself that something is working, in this case, a trading strategy. So let's get started. We'll start with using Y Finance for market data. And Y Finance is great just to get all sorts of market data, and it's free and it works pretty consistently. We're going to look at the TLT bond ETF. So the strategy here is a hypothesis that fund managers rotate out of risky stock positions towards the end of the month before they have to report to investors what they're holding and rotate into safer assets to avoid having to tell the investors that they've invested in the latest meme stock and lost money on. So we want to take advantage of that, and we're going to do that with a simple strategy using the TLT ETF. This might look like a lot of code, but all we're doing is getting data and computing the log return. And we've got this data frame here, and you can see that we then have an extra column called log return. Okay, that's what we're up to. And we just want to assess whether or not we think this strategy has edge before we spend a bunch of time investigating in that case. Okay, so we want to create a couple columns here. So I just dropped all this code in, but basically what I'm doing is I'm adding a new column to the data frame with the day of the month, another column with the year, and then I'm grouping by the day of the month. I'm computing the daily log returns, and then I compute the mean, all in Pandas, right? So I've done 3 or 4 different operations in one line of code, which would take like a couple columns in Excel at least. And I then plot this information and I check to see what the average mean returns are on every day of the month. That's what we're seeing here over the entire analysis period of about 10 years. And we're starting to see something interesting, right? So on average, there seems to be negative returns in the first couple days of the month and positive returns in the last couple days of the month. And that supports our hypothesis that big fund managers are buying TLT at the end of the month and selling TLT to rotate back into their meme stocks at the beginning of the month, okay? So that's, 10 lines of code, 2-3 minutes to understand whether there's something interesting there to investigate, okay? So let's dig a bit deeper. So our strategy will basically look to get short in the first week of the month and long the last week of the month. So I know this looks like a lot, but we're going to create a new column called first week returns and set it equal to 0. And we are going to look where the day of the month is less than 7 in the column first week returns, get the log return and just set it equal in that column. Okay, so it sounds like a lot, and it kind of is, but let's see what this actually looks like. So basically what we end up with is a data frame. We're just building onto this data frame where we've got the log return, the day of the month, right? You can see the date here, July 30th and 22, or 2002 is the year. And you can see that if the date, let's look at the first 15 rows, if the date is in the first week, then we have the daily log return. If not, then we have a 0, right? And we're going to do the same thing with the last week of the month. So same thing, if the day of the month is greater than or equal to 23, give me the column last week returns and set the log return into that column, okay? So when I run this, I end up with the same kind of setup. Let's take a look at the first couple rows. And we see that, in the last month, the last couple days of the month, we have the last week returns. Obviously, this is NAN because it's the first record in our data set where we had to throw it out to compute returns, okay? And then we are going to take our very simple, naive strategy, which is get long the last week and get short the first week. And the big unlock here is how simple it is to mock up a simple strategy, right? We're not doing anything sophisticated. We're not talking about slippage. We're not talking about commissions. All we're trying to do is the bare minimum analysis that we need to provide ourselves evidence that there's edge or not. And what we end up with then is the last column here with the last week returns, which is representing a long position, and the first week returns, which is representing our short position. The difference between those two is a long position and a short position, okay? And you can see what that looks like in that last column. So we're just building on this Pandas data frame. Okay, finally, let's actually have a look. So I'm going to plot this, and I'm going to group by year. First, what I'm going to do is present a bar chart with the annual mean returns. So group by year, give me the last week less first week returns, get the average, and then create this bar plot, right? And we're looking at the average annual return from doing this strategy over the entire 22-year period. We've only lost money twice, right? And this has this is a evolving interest rate environment. Obviously, the TLT, the bond ETF, is sensitive to interest rates, but we have only lost money on the strategy 3 times in the 22 years that we've executed it. We've mocked it up. Okay. So let's look at the cumulative annual returns. So we group by year. We take the same last week less first week returns and we add them. Then we take the cumulative sum and we plot this. And that is an up and to the right equity curve, right? That is a pretty good looking curve. And if we look at this against the daily returns and we plot it against the actual buy and hold strategy, so what if we were just long TLT the entire time? Boom. The blue line is our strategy. The orange line is the buy and hold strategy. And you can see as interest rates have been coming up, right, rising over the last year or two, the TLT price has been going down, and therefore a buy and hold strategy with TLT would have lost us money. But our strategy of selling the first week and buying the last week definitely outperforms that buy and hold strategy. And the last thing we can just do is look at the actual data and say ILOC, give me the last value. And this strategy returned 191%. So almost 2x over that 20-year period with a pretty stable Sharpe ratio. Okay. So the idea here is that we spend the minimum amount of time. So that was a 7-minute and 53-second treatment of a strategy that has known edge, right? This is a very persistent edge. Now, obviously there's improvements here. You can do a rolling analysis. I'm just naively picking the last week and the first week, all sorts of different tweaks to the strategy that you can make, but it's that simple. And with Pandas, it's very, very simple. And you could see how easy it is with just a couple lines of Python. You can come up with this strategy with 191% return. Take care. I'll see you next time. Bye.